Hello and welcome to this brand new edition of Commodity Talk. I have with me Mr. Ross Maxwell. He is Global Strategy and Operations Lead at VT Markets. Hello, Ross. Great to have you with us. How are you doing?
I'm very well, thank you, Shavendra. Great to be here. Thanks for inviting me back. Real pleasure.
Thank you. So let us start. Much has changed since the last time we spoke. Today, I will be speaking about oil, gold, and metals to give our viewers some perspective about what is happening in commodity markets. So, shall we start?
Yes, please do. Let's go.
Okay. Crude oil prices have jumped roughly around 10% this month, but the rise has been mainly because of geopolitical tensions and the risk premium is going up. So, what is your view on the current fundamentals of oil, and will the price be able to sustain if some compromise is reached between Israel and Iran?
Yeah, so again, I think you're right to point out that this spike in oil prices has been driven by the geopolitical tensions. It's been driven by the potential risks and the disruption to oil in the Middle East because of the Israel-Iran conflict sort of thing. I think the fundamentals on oil hasn't really changed. So, if we do see some form of compromise, some sort of negotiated settlement, some sort of de-escalation intentions, then unless there's some sort of real meaningful pickup in demand or meaningful change to the fundamental situation, I would expect to see a correction in prices in oil, another sort of like a sharp downturn to sort of correct back. Because like I said, as you say, the fundamental situation hasn't changed. And a lot of the price increase at the moment is about the potential risks rather than like a current disruption to supply. It's about the dangers of an escalation and the disruption that could have. That's what's caused the price. I think if there is a de-escalation, I would expect to see the prices come back down rather than sort of sustain at these levels, unless there is some sort of meaningful shift in the fundamentals.
Okay. There are starkly divergent views on the prospects of oil. Like, for example, if we talk about some of the Indian brokerages whose reports I read, they are estimating oil prices to sustain $80 per barrel mark with difficulty. But at the same time, if you look at some of the foreign brokerages, the likes of JP Morgan, uh, they have just doubled the prices of Brent. The outlook has been doubled going ahead. I mean, their targets have been between $120 to $150. So, what is your view on this?
Yeah, so I think we certainly could see those sort of prices if there's like a major escalation. I think there has to be like a variety of factors and a variety of things that would have to happen. Like, there's been talk around Iran closing the Strait of Hormuz, which would really disrupt supply. You could see the US get involved again, which would be another escalation. If it turns into a more regional wide conflict and you start seeing sort of Saudi oil fields getting bombed, then, all of these sorts of things
Correct.
could actually then mean that oil prices sort of like spike up to that $120, $150. I don't think, even if we do get there, I don't think it's sustainable. The reason being, obviously, the impact that has then on the global economy and the inflationary issues that it then creates on the global economy will then force central banks, who are already in a very sort of tricky situation, balancing sort of this inflation versus slowing growth issue that we've got at the moment. I think they would have to tighten policy to dampen demand to bring prices back down. So I think whilst you could see an initial spike into those sort of like higher end levels that you're talking about, I think central banks would have to act quite quickly to bring the price back down, because I don't think they're sustainable, certainly for the global economy in that. But, that is sort of like worst case scenario. I think if there's sort of like a real series of escalations within that conflict between Israel and Iran.
So, if I have to reframe my question, I would like to know the base and bull case scenario for oil. I mean, if you have to set a target in the
Yeah.
base case and in the bull case, what targets will that be?
Well, look, I think again, it's very difficult to sort of predict that because it a lot depends on how far the escalation goes. It depends on how much disruption there is. It depends on what the fundamentals are. I think, from a technical point of view, you have to try and think about what is driving fundamentally the moves into those levels. So I think, if we see a de-escalation, I think we can see back down to sort of like that sort of $60-65 a barrel that we were trading at just a couple of weeks ago. Maybe a slight premium to that, so maybe sort of 65, just because of, even if there is a de-escalation in tensions, those tensions still exist, just because they those tensions have been there for decades. They're just because they come to a ceasefire doesn't mean that those tensions go away. So I think you may sort of see go back to that sort of $65. In terms of in the bull case, as I say, I think you may see an initial shock up to that $120 to $150. It depends how much panic buying goes in. It depends on how much supply is disrupted. But I think even after that, you may sort of settle back around the sort of like $90 to $100 per barrel once things have calmed down again a little bit and the central banks have intervened.
Okay.
But again, a lot will depend on how that sort of plays out. There's a lot of obviously moving factors in there, so that would be sort of like my projections for it.
Okay, so there has been a lot of talk about the Strait of Hormuz, and we know that around 20% of the supply goes through that channel. So in the worst case scenario, if escalations grow and if Iran chooses to close that channel, how bad that could be for the prices and for the overall supply?
Yeah, so as you've already said, 20% of the global oil supply comes through the Strait of Hormuz. It's something like 18 million barrels a day comes through that strait. All of the major players in that area, all the major exporters, generally speaking, are using that Strait of Hormuz to transport oil. So clearly, if Iran do decide to close the strait, it's going to have a huge disruption to oil, and that's when you're going to see these sort of big price spikes in oil. Again, where that goes to is a bit unknown. That's when you could get to see that sort of $120 a barrel. But I think one of the main reasons that they haven't done it yet, and they will be reluctant to do so, is because of the impact that it's going to have on the global economy. It's not just about the supply of oil and the price of oil. The impact that it's going to have on the global economy will be quite stark because of the inflationary issues that it's going to create. And therefore, even their allies will then be putting pressure on them to not keep that closed for too long, because they want to open up the supply of oil again. So I would expect them to use it as a bit of a last resort, and if we do see that could be very painful for the global economy, a huge spike in oil prices, and therefore create a real sort of complex headache for central banks in terms of what they need to do to react to that.
Okay, so let us shift our focus to gold. The gold prices have been going ballistic. And that is understandable because of its haven appeal. For traders, it makes sense to ride this rally and make gains. But is it justified for retail investors to buy gold at such lofty valuations? What is your view?
Yeah, so again, it all comes back to what your objectives are as a retail investor, what your strategy is and what your objectives are. If you're looking to sort of like to buy gold and add value to your portfolio in terms of to try and ride this bull trend that gold's been on for 18 months or so now, it doesn't make sense to buy the highs. If you're doing it from a more speculative point of view and you're looking to profit from the run, then as always, I would advise identifying technical levels of support. As long as the fundamentals don't change on gold and the bullish tone continues and these geopolitical tensions continue, then the bull tone's going to remain. And you look to technical areas of support to buy on pullbacks. Even as I say, in this sort of real strong bull run that we've had for the last 18 months, there have been corrections. That no market moves in a straight line. There will be corrections, and I think, from that point of view, if that's your strategy, then you should wait for those pullbacks to enter. But obviously, there are some strategies out there more if you're sort of like hedging, like using gold as a hedging strategy, maybe against inflation or various other hedging strategies. Then you sort of need to participate, because if you need to buy gold as a hedge and you don't participate, then you're actually taking on risk and you're opening up risk, because if the market continues moving higher, you're not hedging yourself at the levels that you need to be hedging yourself at. So obviously, I think the advice on that sort of side of things would be to the dollar cost average in, which means buying in tranches, in levels, so that, if price does pull back, you can still participate at lower levels and bring your price down. But if price continues higher, then you continue buying. You've bought some at these levels. So I think my from a hedging point of view, you need to participate. Otherwise, you're opening yourself up to risk. And trading and investing is all about managing your risk. But maybe do it in a sort of like a dollar cost averaging way to reduce your exposure and risk on that sense.
So basically, buy in a staggered form is what you are recommending.
Yeah, exactly. Yeah.
Okay. Coming back to silver, we've seen silver has also been going great, 20% rally so far in this year.
Yeah.
So just wanted to understand if, not as a hedge, but purely on the basis of demand, industrial demand, what is the current situation for silver? What are you hearing?
Yeah, so obviously silver is slightly different to gold. Obviously, there are some similarities, but it has more of a sort of industrial purpose and stuff as well, silver. So, the Chinese data that came out recently has provided, I would say, cautious optimism for the demand. It was positive data. We know that Chinese growth has been a little bit uneven, and you've still got these sort of tariffs and everything surrounding it. So I think cautious optimism is the best way to say which has driven this sort of price of silver. And I think we're at levels now that hasn't been seen since sort of 2012, 2013. So sort of it's the highest price silver's been at for 12, 13 years. So there's clear bullish tone and sentiment on silver at the moment, due to the demand provided by China. China don't do stimulus in sort of broad terms. They do very much targeted stimulus packages, and they're targeting sort of the solar sector, the EV, electrical vehicle sector, semiconductors, those sorts of things, which is helping it. And as long as that stimulus, that targeted stimulus continues to boost demand, especially from China. We've got global demand because of the investment in green tech, which again boosts the demand for silver. I think that will help support prices in the short and medium term. So I think sort of short term, I don't see any reason, as long as those sort of bullish factors and that bullish fundamentals stay in place. Short term, maybe you're targeting that $38 to $40. And then potentially even up to 45 would be my next sort of technical level of resistance that I would be looking if it breaks through that.
So this July tariff pause deadline is approaching. We are only weeks away. Yeah. So I just wanted to understand, will that tariff apply to bullion, gold and silver also?
Well, I think when it comes to tariffs, I think it's so unpredictable. I think the way that the US administration have handled tariffs and stuff has been so unpredictable. Sometimes they impose a tariff and then they pull it. Sometimes they impose them and then only do it to certain products. I think it's very, very difficult to predict that. I mean, I think the surefire thing would be that if America start imposing the tariffs back on Chinese goods and products which involve silver, then they will retaliate. And I think there's this sort of negotiation to be had there to offset it. I think when it comes to tariffs, like I say, it's such an unpredictable thing, the way the Americans and certainly President Trump has gone about his business with it. I think the way that it's been handled, I think he's shown he's not scared to impose tariffs on anything. but it is very much a negotiating tactic, because as soon as there's any sort of semblance of negotiations to be had, he rolls back again. So I think if there is, I think it would be very short term anyway.
So what is your outlook on the base metals?
Yeah, so again, so you've obviously got renewed optimism. Again, it's that cautious optimism. Targeting Chinese stimulus is not just targeting silver; it's targeting sort of like copper, zinc, aluminium, those sorts of things. And I think demand has increased. I think, we've got to expect short-term volatility due to the unpredictability of those tariffs that we were speaking about.
Yeah.
If as I said, if the tariffs come back into the fray, then I think you're going to see that sort of like that short-term volatility. But I think it will be short-lived, because some American policymakers and some are calling for the tariffs to be put back in place. Some are asking for the pause to be extended, and it really wouldn't surprise me at all if they're imposed again and 3 days later there's a pause, because it's in nobody's interests for this for there to be some sort of long protracted trade war between the two biggest global economies. So I think you're going to expect some short-term volatility in base metals, but I think generally speaking, as I say, cautious optimism that demand is increasing again, and I think as long as there's not some sort of protracted tensions between the trade war, which I don't really expect. I expect them, it may take a while to come to the fully negotiated settlement, because it's such a complex thing and a bit of a power battle between China and America. But I think that sort of settles down eventually, and that demand can increase.
Okay, so are you positive about all the base metals, or do you have some specific metal in mind? I mean, copper, nickel.
Yeah, I think more sort of copper and I think more copper, aluminium. I think would be I'd be more bullish on those. Like I say, I think a lot will depend on how long these negotiations take, and I mean, again, it comes back to that you've got to see sustained demand increase from and a sustained recovery from the Chinese economy. It's very cautious optimism at the moment, and I think as long as that sustains, then the demand increases, and therefore supply is still under pressure, especially on something like silver. So I think I'd be bullish on certainly silver, copper, aluminium, as long as that sort of Chinese recovery is sustained.
Concern. Okay. Coming back to dollar, we've seen that dollar has been on a decline. It has fallen by nearly 9% so far this year, which has, in a sense, kept commodity prices in check. So what is your view on the trajectory of dollar index going ahead?
Yeah, and again, not to sit on the fence too much. A lot will sort of like depend on a lot of these factors that are going on. Trump has made no secret at all that he wants a weaker dollar. Like, he's calling for a 1% cut in base rates just this week. The Fed obviously didn't do that, but he wants. I think he's called for 2.5% cuts in the base rate. Because the reason he wants that is because it supports his America First agenda. So the weaker US dollar, it makes imports cheap, more expensive for American companies. So they look to American companies for supply, and also it makes American products cheaper for foreign companies. So again, boost demand for America. So very much supports his America First agenda. So we've got that where he is trying to drive a weaker US dollar, but the Fed have to balance that out. They've got to be more prudent. They've got to think about it. And this week, obviously, after the Fed meeting, they struck a much more cautionary tone. So they were, we've got slowing GDP growth, so that is the concern, which would support cutting rates. But there is this sticky inflationary issues, especially when they're saying that they haven't seen the full impact of the tariffs yet on inflation, and obviously, as we spoke about earlier in the discussion, the impact that the price of oil could have on inflation. So they're sort of very much keeping their cards close to their chest. They're keeping all their options open, and I think if we see a quick resolution to the conflict in the Middle East and the war in the Middle East, and we see some sort of settlement and a trade agreement between China and America, then I think we could see, a bit of a weaker dollar, because they will want to boost the economy by cutting rates. I think if this war is protracted and it escalates, and if there's no negotiation or the trade wars sort of continue, then the Fed are going to have to increase rates to balance to finally balance that. And it's a very complex and very tricky situation that the Fed find themselves in, because they want to avoid that really painful stagflation environment with a low GDP, like a slowing economy and high inflation. And unfortunately, because of the events of the world, not just in the economy but geopolitically, they're being forced into this, like, to make some very, very tough and complex decisions. So, as I say, I think if we can see some resolutions, which obviously we all hope for, then I think we can see that weaker dollar that President Trump wants. But if it continues, then the central bank may be forced to increase the value of the dollar to offset the other dangers that they face.
So purely from the perspective of trade, will you suggest riding this momentum as far as gold and oil is concerned?
Yeah, again, so in terms of, I think very much more so in gold than I would say oil, because obviously with oil, because it's such a volatile situation, and because the price of oil is going to be very much dictated by things that are unpredictable. So, if there's a de-escalation, you could see a very short, sharp drop in oil, whereas a lot of the fundamental reasons driving gold will remain outside of like some de-escalation there. So I think I would very much more looked towards gold, because it's a little bit more predictable and fundamentally it's a lot more solid. Whereas oil, the fundamentals and the geopolitical thing is a bit more of a standoff. So I mean, look, if you as an investor, I would still be very cautious with oil. As a trader, when there's these short-term volatility, stick to your technical levels, stick to the overall trend in the market, but make sure that you've got your stops in place to protect yourself if you do see this sort of like short-term volatility and that the fundamentals change very quickly, which you can see. So, like I say, I would be bullish gold because the fundamentals stay, but I would be a little bit more cautious with oil.
Thank you so much, Ross. It was a very enlightening discussion with you. It was great having you with us. Thank you so much.
No, thank you very much. Thank you very much, Shavendra. Thanks for having me again, and always a pleasure. Have a great day too.
Thank you. You too.
Thank you.